But you're right. And we've said this. This is a strong, robust economy.
All right, now to inflation, because it has begun to cool, but food prices remain high, and that is making it difficult for many families to afford even basic groceries. Food banks across the country are feeling the impact of high prices, with long lines and new faces as more families struggle to make ends meet.
People have savings on their balance sheet from the period when they couldn't spend and where they were getting government transfers. There's still very significant savings out there.
See, if you've been using your credit card a lot recently, you're among the millions of people who have racked up debt at record rates.
In a few months, there is a good chance that the total credit card balances of people in this country will soon reach a new record.
Finds that only 44% of Americans can cover an unplanned emergency expense of $1,000. With 35% saying they'd need to borrow that money to get by.
The states are very flush with cash.
State of emergency in Jackson, Mississippi, 160,000 people there still without drinkable water. People lining up for hours for cases of bottled water today, some finding they were already too late.
So there's good reason to think that this will continue to be a reasonably strong economy. A reasonably strong economy.
What the are you talking about, man?
All right. Today is Thursday, September 22nd, and this is a recap for the stock market activities today. Folks, I got a good one for you tonight. And look, the action today was supposed to be a lot uglier, but there was a save overnight, or at least we thought so, until of course the digestion started to kick in, and all of a sudden the market decided to take a Pepto-Bismol to the downside. This supposed save, maybe not, came out from the Bank of Japan overnight. We know that the yen has been getting crushed severely, like we have never seen before, at least since the 1990s. And the question was, will the Bank of Japan at some point fold and stop easing their monetary policy and perhaps increasing interest rates higher to shore up the yen once again? Well, now we know the answer. They're not doing that. They're keeping rates as is. But they did intervene for the first time since 1998 to shore up the yen. Now, when they push the yen higher, the dollar goes down. When the dollar goes down, the algos react right away. And the algos like the US dollar to go down because this allows a rally in equities, at least in the metals, materials, energy, those kind of sectors of the stock market, the commodities, but also multinational technology companies because they get a lot of revenues from overseas. They like a lower US dollar. But there is a catch. How would the Bank of Japan shore up the yen? The answer is by dumping US bonds. Well, when they dump US bonds, what happened to yields? Yields shoot up higher again. And we saw the 10-year yield, the 2-year yield shooting up significantly higher today. Now, the algos react to that in a negative way, specifically when it comes to the NASDAQ, the big cap technology stocks, the RKKs, and speculative kind of stocks, the high multiple kind. And therefore, today we saw a contrast in performance between, let's say, the Dow Jones versus the NASDAQ and the Russell 2000. The Dow Jones outperformed, the NASDAQ, the Russell 2000 underperformed. And the reason is a lot of these value names, these material and oil names in the Dow Jones, they reacted positively to the fact that the dollar went down, at least initially, when we heard about the Bank of Japan shoring up the yen. Yet the algos reacted negatively to the fact that the 10-year yield shot up higher and they sold the NASDAQ, technology, the high multiple kind of names. And as a result, the NASDAQ and the Russell 2000 underperformed today. But it wasn't just the Bank of Japan. It was a double whammy, triple whammy, whatever you want to call it, doesn't matter to me, against the US dollar. For example, overnight, the SMB, the Bank of Switzerland, which was the only country with negative interest rates, well, they decided to increase interest rates by 75 basis points and moving out of negative rates territory. Remember, when other central banks start to tighten their monetary policy to shore up their currencies higher, well, guess what happens to the dollar? It goes down. And of course, the SMB is way behind the curve. They have some rosy projections about inflation. And then all of a sudden, month after month, those projections were getting up higher and higher and higher. And here, let me fix this one for you. Oh, here it is, much better. Inflation to the moon. And it wasn't just the Bank of Japan and the SMB. It was the Bank of England. It was the Norwegian Central Bank. It was the Indonesian Central Bank. All of these countries increased their interest rates significantly higher, with one exception, that is Turkey. Over in that country, they actually decided to cut interest rates by 100 basis points. So you might say perhaps inflation is crashing. Over in Turkey, the answer is not really. Inflation is actually at 80%. But of course, genius Erdogan continues to cut interest rates, hoping that inflation will magically go down. And I say good luck, Mr. Erdogan. Best wishes. Maybe US market bulls will move over to Turkey, since the central bank is spreading a lot of yayo over there still. Because the bulls are getting really desperate at this point. They're looking at anything to grasp on. They looked at the action that we got from central banks this week, and they said, oh, look at this. The Norwegian Central Bank, yes, they increased interest rates higher, but they signaled that interest rate hikes are coming to an end. And of course, the bulls right away went, maybe Jerome Powell, maybe the Federal Reserve will also put an end to interest rate hikes. I say not so fast. Unfortunately, of course, because yesterday Jerome Powell came out as Dark Powell. He certainly did not walk the walk by increasing interest rates by 100 basis points, or perhaps more, but he did indeed talk the talk. And there was a lot of talk. So let's go over what he said, and here it is, in focus tonight. Introducing Dark Powell, no longer Dove. For good this time around. 100% sure. And he's not just only a hawk. He's becoming a Maverick of Wall Street kind of hawk. You know.
Some men just want to watch the world burn.
And by now you know the deal. They did the 75 basis points, plain vanilla. They added a bunch of sprinkles and M&Ms, and they said, okay, here you go. Please don't buy stocks. Please press the sell button. Please short more. The Fed is in your side. Don't fight the Fed. And of course, we're going to talk a lot about unemployment because this is the missing block. You want the Fed to stop, unemployment must rise higher for inflation to go down. And of course, every time, just like the SMB, month after month, they continue to raise their unemployment projections. And I say, let me fix this one for you. Here it is. Much better. To the moon. But what I would like to do here is, let's go over certain statements. We start with the bearish ones. Hawkish ones? Because we must answer two important questions. What is the magnitude of pain that Jerome Powell is looking for in the economy? And number two, when is he gonna pivot? And here's an extra one. Number three, what indicators should we be looking for? And he answered all of these questions. Let's start by Jerome Powell reiterating his stance from Jackson Hole. Take a listen.
The main message has not changed at all since Jackson Hole. The FOMC is strongly resolved to bring inflation down to 2%. And we will keep at it until the job is done.
So Dr. Payne said, I'm not joking about what I said. I mean it. I want to see a lot of pain. What kind of pain are you looking for, Mr. Powell? Well, here it is. Take a look.
What is that economic pain in your mind? Is it job losses? Is it higher interest rates on credit cards? What is that economic pain?
So it's all of those things. You know, higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve. But they're not as painful as failing to restore price stability and then having to come back and do it, down the road again, and doing it at a time when actually now people have really come to expect, high inflation. If the concept of high inflation becomes entrenched in people's economic thinking about their decisions, then sort of getting back to price stability, the cost of getting back to price stability just rises, and so we want to avoid that. We want to act aggressively now, and get this job done, and keep at it until it's done.
And is there a painless way to do this, to take inflation down? Because you got genius Senator Elizabeth Warren now criticizing Powell, saying maybe we should let inflation go. MMT, baby, to the moon. And I thought Republicans are the ones who were telling Powell, please stop tightening the monetary policy, keep the money loose so we can goose up Wall Street and the oligarchs and the real estate market. I thought this is what these Republicans stand for. But all of a sudden, Elizabeth Warren is now standing with that same side, saying, Mr. Powell, stop tightening the monetary policy, please. More easy money for the billionaires. So again, Mrs. Warren and everybody else, is there at this point, at this stage, we can talk about, spilled milk from last year, or the Fed should have raised interest rates higher last year. No other channel, no other outlet has been beating on this drum over and over and over and over again than this channel. But we're here now. And at this stage, since the Fed is too late, is there a painless way to get rid of inflation? Here's Dark Powell once again.
If we want to set ourselves up, really light the way to another period of a very strong labor market, we have got to get inflation behind us. I wish there were a painless way to do that. There isn't. So what we need to do is get rates up to the point where we're putting meaningful downward pressure on inflation. And that's what we're doing. And we certainly don't hope. We certainly haven't given up the idea that we can have a relatively modest increase in unemployment. Nonetheless, we need to complete this task.
And oh, by the way, what happened to the soft landing? I guess the soft landing is kaput right now. Take a look.
In addition, the chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer. Nonetheless, we're committed to getting inflation back down to 2% because we think that a failure to restore price stability would mean far greater pain later on.
And if you thought that was enough, you're already crying with the tissues, you already shit your diaper, we'll grab another one. Because Jerome Powell says, I want to see pain in the stock market. Stop buying the dip, you morons. Take a listen.
Of course, monetary policy does famously work with long and variable lags. The way I think of it is our policy decisions affect financial conditions immediately. In fact, financial conditions have usually been affected well before we actually announce our decisions. Then changes in financial conditions begin to affect economic activity fairly quickly, within a few months. But it's likely to take some time to see the full effects of changing financial conditions on inflation. So we are very much mindful for that. And that's why I noted in my opening remarks that at some point, as the stance of policy tightens further, it will become appropriate to slow the pace of rate hikes while we assess how our cumulative policy adjustments are affecting the economy and inflation.
And this is really important because Jerome Powell says, I know that there is a lag. Whatever I'm doing right now in increasing interest rates, that's going to show up later. But what is the explanation behind that? The explanation is financial conditions tighten. That is the first step. And then little by little, we see that tightening of financial conditions being spread all over the economy in terms of higher unemployment and a slowdown in the pace of economic activity, aka slowing down of the demand in the economy. And that leads to lower inflation. So Jerome Powell told us that we have to keep an eye on financial conditions. And pay attention now. At this stage, they cannot afford to let financial conditions get loose again. They have to get financial conditions as tight as possible for inflation to go away. So when we look at financial conditions right now, they're indeed tightening. But the devil is always in the details. You see, this is the Chicago Fed National Financial Conditions Index. Financial conditions tighten when we see the readings in this index shooting up higher to positive, above zero, just like we saw back during 2009, 2008, and just like we saw back in 2020. Look at financial conditions right now. Yes, we're tighter than a few months ago, but we're not really that tight. We're not tight enough for inflation to go away and be removed from this economy. We dig deeper. This is really important. Pay attention now. What happened in 2022? You see that little dip in financial conditions? The reading went tight for a little bit, but then it went down. Why? Let's zoom in a little more. Here it is. Remember what happened? The so-called June bottom, the summer rally, well, that pushed financial conditions to loosen, not to tighten. In other words, for financial conditions to tighten to the point where the Fed says, okay, this is good enough to extract inflation out of the economy, this reading has to go higher, much higher than it is right now. In other words, if you geniuses keep buying the dip over and over and over again and loosen financial conditions with these bear market rallies, I, Jerome Powell, have to whack your little head even harder to get the message through. I want to see financial conditions tightening significantly for inflation to go away. And what you geniuses are doing by buying the dip over and over again, you're effectively screwing with my progress. So I have to come out even more aggressive. No wonder why he had to come out in Jackson Hole and do the Dr. Payne speech. Do you understand now that buying the dip is suicidal at this point? Now, let's go back to Dr. Payne, but this time around, I want you to grab a pen and paper or iPad, whatever you use, doesn't matter to me, and take some notes. Jerome Powell is going to give us 3 conditions for when he's going to say, okay, we've done enough, now we pause. in terms of increasing interest rates further? Let's see if we can catch all of them. Take a listen.
What will we be looking at, I guess, is your question. So we'll be looking at a few things. First, we'll want to see growth continuing to run below trend. We'll want to see movements in the labor market showing a return to a better balance between supply and demand. And ultimately, we'll want to see clear evidence that inflation is moving back down to 2%. So that's what we'll be looking for. In terms of reducing rates, I think we'd want to be very confident that inflation is moving back down to 2% before we would consider that.
So this is what I got in my notes. He wants to see growth moving down. He wants to see unemployment moving higher. And he wants to see inflation moving down. What does that mean? What is this an ingredient for? And the answer is a recession. What else should we be looking for, Mr. Powell? Because why is he front-loading all of these interest rates hikes right now, doing the 75 over and over and over again? What does he want to see? If he has to name one indicator, take a listen.
What's the incentive to continue front-loading right now? Is it lack of progress on inflation seen in the CPI reports, or is it a motivation to get as much done while the job market is still as strong as it is?
So what we've seen is inflation our expectation has been that we would begin to see inflation come down, largely because of supply-side healing. By now, we would have thought that we would have seen some of that. We haven't. We have seen some supply-side healing, but inflation has not really come down. If you look at core PCE inflation, which is a good measure of where inflation is running now, if you look at it on a 3, 6, and 12-month trailing annualized basis, you'll see that inflation is at 4.8%, 4.5%, and 4.8%. So that's a pretty good summary of where we are with inflation, and that's not where we expected or wanted to be. So what that tells us is that we need to continue, and we can keep doing these, and we did today do another large increase as we approach the level that we think we need to get to. And we're still discovering what that level is, but people are writing that down in their SEP where they think policy needs to be. So that's how we're thinking about it.
So Powell says, I have to front load all of these interest rate hikes because the core PCE, are you listening or not? The core PCE, forget about the CPI, core CPI, PCE. He's looking at the core PCE. And until the core PCE gets closer to 2%, the Fed's target, they're not going to stop raising interest rates. They're not going to stop tightening the monetary policy. In other words, let's say the core PCE right now stands at above 4%. That is double the Fed's target of 2%. In other words, back to Volcker, how do we defeat inflation? By raising interest rates above the rate of inflation. Okay, you might say, hey, the CPI has rents and housing, and that could tilt things one way or the other. And the headline readings with energy and food, those are volatile. Okay, let's play that game. You want to play that game? Let's play the game. Let's use core PCE, which stands at above 4% right now. This means the Fed has to increase the Fed funds rate above that number. In other words, 5%. We are now at 3.25. So by my calculation, we have at least 175 basis points worth of hikes coming. The sooner, the better. And Jerome Powell understands that. So why isn't he doing it right away? Just get it out of the way. Go ahead and do the 5% right now. Shock and awe. Get inflation out of the system right now. This is what we mean when we say the Fed is behind the curve. Look at what the 2-year yield is doing. The 2-year yield is above 4% right now. And it is saying, Mr. Powell, can you catch me or not? You're not in the driver's seat. I am. A next step will be the 2-year goes to 5%. Now Jerome Powell goes to 4%. And then the 2-year goes to 5.5%. Jerome Powell has to go to 5%. And it becomes a cat and mouse game that is so dangerous. But if Jerome Powell goes above the 2-year right away and moves interest rates to 5%, effectively he tells inflation, I'm in charge, not you. And now I'm going to push you down and you're going to follow my lead. But do you think Jerome Powell has the balls to do that? Of course not. Now, was there anything bullish, anything dovish in the conference that we got yesterday? The answer is maybe a point or two. Here's point number 1. Jerome Powell again shifting the blame from his own monetary policy mistakes to, oh, these are just supply shocks. But he also says something important. Let's see if you can catch it.
Part of this inflation is caused by this series of supply shocks that we've had, beginning with the pandemic and really with the reopening of the economy. and more recently amplified and added to by Russia's invasion of Ukraine, have all contributed to the sharp increase in inflation. So these are the kinds of events that are not really seen in prior business cycles. And in principle, if those things start to get better, and we do see some evidence of the beginnings of that, it's not much more than that, but it's good to see that. For example, commodity prices look like they may have peaked for now. Supply chain disruptions are beginning to resolve. Those developments, if sustained, could help ease the pressures on inflation.
So now, of course, he shifts the blame to supply shocks, the thing, Russia, Ukraine. And he says, look, some of these supply shocks are resolving themselves. Or we're seeing commodities futures going down. He said peaking, maybe. So that is one tiny glimpse of hope that the bulls can hold on to, which is what if futures, in case of commodities, continue to go down? That would be a bullish sign that Jerome Powell perhaps will see it as inflation moving down. The problem is, look at what's going on with wheat. Look at what's going on with natural gas, with crude oil futures. They're moving higher again. Okay, what else? Do we have anything else that is bullish or dovish? Yeah, kind of. We have the fact that Jerome Powell, after saying that the soft landing is kaput, he came out later on and said, oh, maybe we're still keeping an open mind that the soft landing could happen at some point. Take a listen.
First, and you know these, but first, job openings are incredibly high relative to the number of people looking for work. It's plausible, I'll say, that job openings could come down significantly, and they need to, without as much of an increase in unemployment as has happened in earlier historical episodes. So that's one thing. In addition, in this cycle, longer-run inflation expectations have generally been fairly well anchored, as I've said, there's no basis for complacency there. But to the extent that continues to be the case, that should make it easier to restore price stability.
And of course, let's conclude by the fact that Jerome Powell remains delusional, a delusional madman, despite the fact that he's getting darker. Because in conclusion of this conference, he went on and said this.
We've written down what we think is a plausible path for the federal funds rate. The path that we actually execute will be enough. It will be enough to restore price stability. So this is something that, as you can see, they've moved up, and we're going to continue to watch incoming data and the evolving outlook and ask ourselves whether our policy is in the right place as we go.
And I say, Mr. Powell, good luck. If you think your trajectory is going to do the job in killing inflation, good luck. You're not going to kill inflation until you get ahead of inflation, until you move interest rates above the 2-year, above the core PCE. Then you got a fighting chance. But with this course of action, being a chaser, a follower, not a leader, you're keeping inflation in charge. What if these supply shocks intensify for whatever reason? Natural disaster, Russia, Ukraine, and we see inflation moving higher again. Then you get a chase and come out with even a larger interest rate hike. But hey, rest assured, if you thought that this is just FUD and I'm just scaring people and all of that, you got JP Morgan to soothe your pain and your fear. JP Morgan says the Fed will save the stock market and cut interest rates if a deep recession occurs next year. So buy stocks now, damn it. We're holding a massive bag. At least this is according to Kalanovic from JP Morgan. Buy now, then the stock market crashes, the economy gets into a deep recession, and at that time, the Fed is going to pivot, cut interest rates, and stocks go higher again. And from that point, it takes you 3 to 4 years to get back to even. Genius, isn't it? Anyhow, folks, let's move on and cover the stock market information for you because we have a lot of important discussions, specifically when it comes to the dollar, the chart of the US dollar. But let's start with the closing of the indices today, and here we go. The Dow Industrial Average closed in the red, down by 107.10 points, or a loss of 0.35%. The Nasdaq down by 153.39 points, or a decline of 1.37%. The S&P 500 down by 31.94 points, or a decline of 0.84%. That last-minute puke that we all saw by the closing bell. Otherwise, equities, the Dow Jones was positive until the last-minute puke. And as a result, the performance of indices was abysmal. Once again, no metals at all in the red, led by cyclicals, industrials, and technology. The advance to decline ratios, NYSE a pathetic 17% advancing versus 81% declining. 81% I should say, declining. The Nasdaq 16% advancing versus 81% declining. Now again, we keep saying this all the time, with such suppressed ratios, you got one of two things. Number one, a big crash is in the process right now. Number 2, we have oversold conditions in the technicals, and we should get a rebound at least in the overnight futures, if not in the morning session. We'll talk about that a little more in the conclusion of this video because we have an important event tomorrow. But before we do that, let's move on to commodities. And look at what happened here. Crude futures went higher for the day, and the reason is the yen went higher. Dollar went down initially, so we're seeing some commodities moving higher, although the dollar closed well above the lows. And that leads us to what I talked about a few days ago when I said, hey, watch out, we're going to see the Fed versus the ECB coming, the currency wars. And this is going to be a race to the bottom, because when the Japanese shore up the yen and push the dollar down, well, guess what happens? Crude futures move higher. Metals futures move higher. Commodities futures move higher in general, of course, and that produces more inflation. And then the Fed has to respond and become even tighter in the monetary policy and raise interest rates by more. The dollar goes higher again, and guess what happens? The yen goes down, the euro goes down, the pound goes down, producing more inflation in those countries. Why? Because let's say the value of the pound goes down. Well, now it takes more to buy any of these futures using the dollar. And by that alone, costs and prices go higher. So then what do they have to do? The ECB, the Bank of England have to raise interest rates even higher to push the value of the euro and the British pound higher. Then the dollar goes down. But we see commodities in the US dollar moving higher again. Then the Fed has to respond. It goes back and forth, a race to the bottom, which could increase the risk of a recession significantly higher. Now today, crude futures were higher. The WTI, Brent, so was the gasoline, RBOB, so was heating oil, but natural gas was down by about 7% today. And of course, somebody's looking for the arbitrage opportunity, and that somebody is Erdogan of Turkey. He wants to buy U.S. natural gas and then sell it for a higher price for European customers. In other words, we have a floor, we have a put on natural gas prices here in the U.S. If they get down too much, somebody's going to scoop them to sell them back to the Europeans. What about softs? We have modest gains for OJ, a little over 1.5%. Coffee was up by about 1%. So was sugar, up by about 1%. But look at this, lumber is down big by about 7.25%, followed by cocoa futures down by almost 1.5%, and then modest declines for cotton futures for about 0.5 percentage point. When it comes to metals, mixed picture here. We have platinum down by about 1.25%, but then we have muted reactions from gold and copper, and then we have positive reactions from silver and palladium. The confusion is clear, and the reason is the dollar went down initially after the yen went higher, but then the US dollar recovered as the US trading in the stock market started. And this is, by the way, a signal of the relative strength of the US dollar. Even with the Bank of Japan, with the SMB, with the Norwegian bank, with all of these central banks increasing rates higher, the dollar remains resilient. And the dollar is a friend and a foe for both the Fed and market participants. Why? Because a higher dollar keeps a lid on inflation, specifically when it comes to commodities inflation. On the other hand, the higher dollar erodes corporate earnings and it lowers the GDP. So it is a double-edged sword for now. And the evidence is, look at copper. The fundamentals for copper, for example, are still pretty good. The demand is projected to be a lot higher among most countries, and the reason is the demand for EVs. Copper goes in the lithium-ion batteries, the wirings of EVs, etc., etc. The demand is sky high. It will remain high for years to come. So the tailwinds are intact for copper. The tailwinds for natural gas are intact. The tailwinds for crude oil are intact. But we have a massive headwind. That is the rise in the US dollar because the Fed is tightening the monetary policy. And the dynamic for now is the headwinds are much stronger, are more powerful than the tailwinds. But the moment the Fed eases and the value of the dollar goes down, we will see all of these commodities shooting up higher because the tailwinds remain intact. In other words, the Fed right now cannot afford to take their foot off the pedal of the tightening, whatever you want to call it, doesn't matter to me. But they cannot pause or pivot or even cut rates at this point because the moment the dollar goes down, all of these commodities will explode higher, causing more and more inflation. Anyhow, what about meats down across the board? Feed or cattle, live cattle, lean hogs, all down. When it comes to grains, we have modest gains for soybean oil, about 2% along with canola futures, and then about 0.5 percentage point worth of gains for wheat. Corn was flat pretty much, be it in the green. And then we have losses led by soybean meal, followed by rough rice, oats, and soybeans futures. Moving on to the big casino, the options market, what's going on here? The volume remains, I would say, below average, but it is moving higher in certain names. specifically Tesla, aka the souffle, came up number 1 with around 2.5 million contracts traded today. About 51% of those were calls. And at number 2, Apple. We'll talk about Tesla more, by the way, in a second because we have a short gamma today. But anyways, Apple at number 2 at around 1.7 million contracts traded today. Once again, more puts than calls. This time around, about 54% of those were calls. Apple is going to go down, no doubt about it. And at number 3, Amazon, with around 850,000 contracts traded today, about 50% of those were calls. Now let's talk about Tesla here. These are the calls with the expiration date of tomorrow. Now when we look for a gamma squeeze, we look for a sudden surge in the volume for out-of-the-money calls or puts. The higher the volume, the stronger the gravity. If the calls outnumber the puts, we have a gamma squeeze. To the upside, of course, the traditional gamma squeeze. But if the puts outnumber the calls and they happen to be closer to the money, meaning where the stock is trading at the moment, then they have a stronger force of gravity. And we see a short gamma. We see the stock getting pulled significantly to the downside. Well, let's see what happened today. The calls for tomorrow's expiration, for the 290 calls, we got about 88,000 contracts traded for the day. Now, this is the closest contract to the money at the closing. Yet the closest contract when Tesla was trading in the morning was the 295 calls. We got about 113,000 contracts traded for that one. Now, let's contrast this with the puts. And as you can see, the 290 puts, the volume outnumbered the 295 calls. In this case, over 166,000 contracts traded for the 290 puts. In other words, the force of gravity was to the downside. Buyers of puts outnumbered buyers of calls, and therefore we got a short gamma to the downside. And this will likely continue in tomorrow's session, and the reason is, look at the next put closer to the money right now. It is the 285, and the volume was over 104,000 contracts for that one. On the other hand, the closest call to the money right now, the 290, did about 88,500 contracts today. So once again, buyers of puts outnumbering buyers of calls, and this will move the stock to the downside. Now, what about the unusual activities that took place in the options market today? We start with the ticker VJK, and this is for the European ETF. Somebody sees more downside coming, and they did a put spread. They bought the 46 puts and sold the 42, all for the expiration date of November 18th, with expectations that the VJK could go down by more than 5% by then, but not more than 13%. They paid around $1.25 a piece for buying the 46 puts, and they received about half a buck a piece from selling the 42 puts. All in all, the entry cost is reduced to about 75 cents a piece, bringing the total to about $2 million. And then what about the ticker IYR? This is for the real estate ETF. Somebody sees upside coming, meaning yields will go down. And they did so by buying a call spread. They bought the 94 calls and they sold the 98, all for the expiration date, December 16th, with expectations that the IYR could move higher and gain more than 8% by then, but not more than 13%. They paid around $1.25 a piece for buying the 94 calls. They received in credit about 55 cents a piece from selling the 98 calls. All in all, the entry cost is reduced to about 70 cents a piece. That brings the total to about $1.3 million. And then we have the trade for the ticker ARKKKKK for Tesla witch Cathie Wood. Somebody sees more downside this time around, and they bought the 35 puts for the expiration date, November 18th, with expectations that the name could go down and lose more than 9% of its value by then. They paid around $2.30 a piece to enter this trade, all in all spending around $3 million. What about the ticker UPS for, you guessed it, UPS? FedEx went down big, along with it UPS. Somebody thinks that this is an over punishment for UPS, and FedEx has its own problems, so they see more upside here, a rebound for UPS. They bought the 182.5 calls for the expiration date, October 21st, with expectations that UPS could rebound and score gains of over 9% by then. They paid around $1 a piece to enter this trade, all in all spending around $1 million. And then what about the XLK, the technology ETF? Somebody sees more downside coming, and they bought the 105 puts for the expiration date, November 18th, with expectations that the XLK could go down and lose more than 16% of its value by then. They paid around $1 a piece to enter this trade, all in all spending around $1 million. And lastly, at the bottom of the table, what about the ticker SPY for the S&P 500. Somebody's hedging or making a downside bet, a bearish bet, by buying the 348 puts with expiration date November 18th, with expectations that the name could go down and lose more than 7% of its value by then. They paid around $6 a piece to enter this trade, all in all spending around $3 million. Moving on to the heat map, what's going on here? Mostly a bloodbath across the board with few exceptions. In technology, we have Microsoft. It outperformed today along with CRM, Salesforce. We know Microsoft was the underperformer in big caps as of late, so perhaps we're seeing some short covering here. Salesforce, on the other hand, came out with a rosy outlook for 2026. Okay? They can't even see what's going on next month, let alone 2026, but the pump is always out there. And then we have outperformers in auto manufacturers, for example, in Toyota. The yen went higher, Toyota went higher along with it. And then we have healthcare, the clear outperformer today, big pharma names, Eli Lilly, Merck, Bristol Myers. Some of these names are making new highs, such as Merck, for example. These are the value names, at least for now. There is no recession here, folks. They're going to continue to steal the taxpayer money out of Medicare with no oversight at all. And then we have an outperformer in metals, chemicals, copper. Some of these names went higher, and the reason is the dollar was down. But besides that, we have weakness across the board. Nothing to see here. The expectations are more weakness to come. So let's talk about some corporate news here, and we start with the souffle, Tesla. We have a recall of over 1 million vehicles, 1 million souffles. And the reason is the window, when you roll it up and you have your finger on, it doesn't stop. It's going to take your finger out. And of course, we know the Tesla culties, the fanboys, they will say, well, this is a new feature. You can use the windows as nail clippers. Thanks, Elon. Anyways, and then we have NVIDIA. Bad news from NVIDIA. NVIDIA was down big today. You see, it's the battle between Jim Cramer and Mama Cathy Wood. Jim Cramer is short, Mama Cathy is long. For now, Jim Cramer is winning because NVIDIA CEO says, hey, we're going to raise prices even higher now. Although the demand is going down, a recipe for disaster. But they have no other choice. If they keep the prices as is, their margins will come down crashing. So these companies are grasping for air right now. You might have heard from FedEx, similar story. They're raising rates, yet the demand is going down. This is a sign for desperation. This is a sign that the margins of these companies will get crushed dramatically. And all of these analysts who did not update their earnings guidelines, and they still have the rosy picture that earnings are going to be okay, you better start updating your earnings target right now because you got them wrong. They're all wrong. You have to go down, downgrade all of them, and this will initiate the next leg to the downside in the stock market. Here is the heat map for the ETFs. What's going on here? Bloodbath across the board. Nothing is up. Even in commodities, we have underperformance in commodities. The only outperformer was the EWJ in international. This is the Japanese ETF after the pump of the yen, which I firmly believe is not going to last. And then we have the EWZ blasting higher. This is going to be really volatile ahead of earnings, or excuse me, ahead of the elections. And of course, it is sensitive to the dollar going down because when the dollar goes down, commodities go higher. EWZ Brazil is a commodities giant. Now let's move on to charts, and we start with the SPY 30 minutes chart. What's going on here? We talked about 373.5, and this was the support for now, at least for today, but the chart is forming a bear flag pattern. This is the 30 minutes chart once again. Are we seeing oversold conditions in the RSI and the MACD suggesting that we could see a pop tomorrow? Maybe, but they're not really oversold by much. So for now, the assumption is if the bear flag plays out, we're going to lose 373.5. In all likelihood, the chart couldn't and will not find support at this number. So it has to go down. If we zoom out to, let's say, an hourly chart, excuse the mess, we have a gap down at around 368. That would be support number 1, and support number 2 is the so-called June bottom. And here is the daily chart for the continuous contract for the SPY. I was about to say the NASDAQ, but this is the S&P 500. And again, the destination for now is the next support at 3,720.5. If that doesn't hold, we go down to the so-called June bottom. For now, all indicators say more downside coming. The volume is moving higher on down days. The momentum indicators remain negative and they're accelerating their way to the downside. There's nothing to see here. We have to seek support downstairs. And of course, the psychology goes, Let's wait for the June bottom and then we'll take it from there. And if I was a bull, I would say, let's do it. Let's get it out of the way, flush it down all the way to the June bottom tomorrow. And let's get the RSI and the MACD really oversold, and then we have a better chance at a rebound. And here it is, the Q's 30 minutes chart. What's going on here? Similar story. We got a gap down all the way to 280. It appears for now that we have a bear flag pattern. Despite the oversold conditions, the RSI and the MACD, we could not find support at 280. Are we going to find it tomorrow for some weird reason? Of course not. So the likelihood is 280 is not going to hold. If 280 doesn't hold, we have the so-called June bottom next. And for that, we move on to the daily chart for the continuous contract for the NASDAQ. The June bottom is 11,058.5. Let's just do it. Let's go down there tomorrow. Let's have a massive flush down, get it out of the picture, get the RSI really oversold, and maybe the bulls are going to have a better chance at a rebound, a double bottom kind of optimism. But for now, the volume is moving higher on down days. The momentum indicators are accelerating their way to the downside, a negative divergence. The bears are completely in charge now. And the weekly closings matter, by the way. Here's the IWM 30 minutes chart. What's going on here? It was the underperformer versus the SPY and the NASDAQ. It was down by over 2% today. It lost an important support of 174.22. It is forming a bear flag pattern. It is not really that oversold on the 30 minutes at least. The next support would be 168.90. And here it is, the dollar, the most important chart for the week, for the day, for the year. It went down initially after the Japanese pump, but then it recovered and it closed pretty much at the highs of the day. This is a sign of resiliency in the dollar, and it is a sign that the dollar is Tony Montana, and he comes out saying, say hello to my little friend. The ECB is shooting at it, the Bank of Japan is shooting at it, the Swiss bank is shooting at it, but the dollar, the Fed has the bigger bazooka. Of course, until something breaks, and then he falls and dies. But until that happens, this is bad news for equities and gold. But perhaps we have a glimpse of hope here if we zoom in to, let's say, a 30 minutes chart. At the time of the recording of this video, it appears that the dollar is forming a bear flag pattern. Not a decisive one, but it is a glimpse of hope for the bulls. If the dollar overnight makes new highs, forget about it. And here's gold, still consolidating in a bear flag pattern. Could not make it to crack above 1,685. For now, the outlook remains bearish until we see the dollar moving down. We see gold recapturing 1,685. What about Brent oil, a daily chart? What's going on here? The bulls still have a lot of hope. They gave it another shot at the sloping line of resistance. Could not make it, but that doesn't mean they're dead yet. They're dead once they make a lower low and they lose 85 as support. Here is the 10-year yield, the massive pop. We explained why in the intro of this video. The Bank of Japan dumping bonds and yields go higher. Are the technicals overextended and they're begging for a pullback? Yes, they are. But until we see the reversal, we can't just trade on the prospects that a reversal will happen. We have to see it to believe it. Likewise, the 2-year yield also exploding higher. Yes, the momentum indicators are way overextended, but that doesn't mean shit. Until we see the reversal based on a catalyst, a fundamental catalyst, we cannot trade on the prospects of, or the 2-year is going to go down. And here's the TLT, weekly chart. Bond bulls got a painful lesson today. We heard a lot of talk over the weekend. And on Monday, for example, Gunlock came out on TV crying again, saying that it is a good opportunity to buy bonds at this point. Not really. We gotta wait and see when the 2-year, the 10-year are gonna top. For now, we have no indicators whatsoever that they're gonna top anytime soon. And the TLT continues to go down. This is a weekly chart. Look at the MACD. We're about to see a negative crossing for the week. If that is the case, we have another flush down coming in the TLT and another pop in the 10-year. Here's the VIX 4-hour chart. What's going on here? It remains in consolidation. The VIX is having a hard time popping higher. The VIX needs another shoe to drop before we see market participants being really afraid and they rush in pushing the VIX higher. That could happen in the next few days. But for now, at least, the assumption is the consolidation will be resolved to the upside. Here's Apple. What's going on here? No update. It went down by a little bit, still above 150, but it is a matter of time before we see the ABC pattern playing out. We see Apple losing 150 for good. Tesla, massive sell-off today, an underperformer, and the next support is 280. But it is getting a little oversold here on the hourly chart. The assumption is we could see a bounce tomorrow, perhaps a gap and crap, but this is not guaranteed. For now, the bulls lost control and they handed it over to the bears. And the bears are going to be vicious at this point. They're going to double down, triple down in buying these puts, creating more and more short gamma, and the market dealer has to sell Tesla shares. They have a lot of them. They don't need them anymore. And when we look at the daily chart for Tesla, is all hope gone for the bulls? The answer is not really, because we still have the prospect of a reverse head and shoulder pattern. These hopes go out of the window once Tesla closes below 279.35 and we see it crossing a decisive one on the MACD to the downside. But until then, the bulls still have some hope here. Yet the bears are going to counter and say, forget about the reverse head and shoulder. Don't you see it already? We have a triple top. The chart is dead. It's gone. What about tulips? BTC, what's going on here? A 4 hours chart. I would say that the reverse ABC pattern here is not going to happen. We might go down for Bitcoin, but it's not going to be because of an ABC pattern. It actually looks a lot more like a failed bull flag pattern that could not make it above 20,000, and that failure produced a bear flag pattern, at least for now, which should produce another leg to the downside, unless of course they crack above 20,000, recapture that as support. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the manufacturing and services PMIs. These will be critically important. Most importantly, we have Jerome Powell, the big dog, once again, speaking. Whatever he's going to say, whatever comes out of that hole might change things. He might backtrack things from the conference by accident. He might double down by accident and slip and say something really hawkish. So the assumption here is, let's say we open down big. We see a gap down. Then Jerome Powell comes out and we see a reversal and more buying all the way till the end. And vice versa. We could see a gap higher. Market thinks it's out of the woods. Then comes Jerome Powell and we see more selling all the way till the end. This is just an assumption. I don't know if the Jerome Powell, whatever this is, conference, interview, whatever that is, will be important or not. We'll see what happens. But folks, this is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again over the weekend.
It must really be something making stuff up all the time.
Yeah, it teaches you to lie.
How's that?
You make stuff up. It has to be believable. It's called suspension of disbelief.
I like that. Suspension of disbelief.